Sorry, I'm just going to turn off my... Oh.
Good morning, everybody. Welcome to this RBK, Bishop Fleming and SwiftFile presentation this morning, an Anglo-Irish presentation collaboration. My name is Chris Walklett. I'm an international tax partner working for Bishop Fleming, and I'm very pleased to be chairing this morning's session. In 2016, as you will painfully be aware, the UK voted to leave the European Union. It was long expected that we would leave on the 29th of March 2019, but it wasn't till the 11 p.m. on 31st of January 2020 that the UK left the EU and entered into a transition period. On that same day, the World Health Organization issued a global health emergency for only the 6th time. And instead of embracing Brexit transition, the globe started embracing a global pandemic. Hopefully with the advent of vaccines, we might now starting to become back to build back better, but building back better in an Anglo-Irish perspective also means embracing Brexit. Since the 1st of January 2021, all goods passing between Great Britain and Ireland need to pass through customs checks, new paperwork and other issues which are already hitting the media in terms of friction and stuff not quite working in the we've agreed a free trade agreement type way. Joining me this morning to discuss this, we have Ronan Mcgivern, International Tax and Business Advisory Partner at RBK, who has a lot of experience, over 20 years experience advising on international VAT transactions and international transactions more broadly. My colleague Wendy Andrews, VAT Director from Bishop Fleming, a substantial amount of experience working in the UK and across Europe with our European partners on international VAT issues. No doubt many of them driven by the EU exit. Excuse me. And finally, Brian McNamara, MD of SwiftFile, a full-service custom clearance advisory firm, also assisting clients with custom setups and advising on the risk and benefit of customs special procedures. So I'm going to hand over first to Ronan, who's going to start us off with a session on Irish VAT.
Thanks, Chris. Good morning, everybody. I think it's no over-exaggeration to say since January, when I came back from leave from the Christmas holidays, the phone was literally hopping, calls after calls, Zoom calls, all in relation to VAT, Brexit, what's happening, what do I do? And that hasn't stopped for the last 2 months. It's just been constant VAT, working with Irish businesses trying to do business in the EU, in the UK, and working with a lot of UK businesses that are trying to restructure and trying to grapple with the new reality that we find ourselves in. So maybe today, I'm delighted to be here with Chris, Wendy and Brian. We definitely saw within the market, what struck me was the confusion amongst people within Ireland and in the UK. Totally changed landscape. People confused, looking for information, ringing customs, getting different answers. Nobody really knew what was actually going on. Everybody knew Brexit was here, but what does that actually mean? Huge amount of the skill set that we had both in Ireland and the UK in the context of customs and clearance procedures has been lost since the 1970s. So automatically, so it's fantastic to have Brian on board today. That skill set is going to have to come back into how we do business, and getting that insight is going to be important. So Deirdre, do you maybe just want to flick on to the agenda that I'm going to talk through today? Is I'm going to look at the Irish side of things. What I will start off with doing is an overview and useful definitions. Some of the topics that I will talk about in the definitions will feature right throughout all three presentations. So it's quite important that you be able to refer back to when we talk about Incoterms, etc., what we're talking about. They're relevant for the UK and for customs. I'm going to look at Irish businesses supplying to the EU, just give you an update as to where things are at. Then I'm going to expand it into Irish businesses exporting to the UK, excluding Northern Ireland. As Chris said, it's Great Britain. There's a nuance in relation to Northern Ireland and its role. Going to look at Irish businesses importing from the UK, from Great Britain, and then going to look at the Northern Ireland Protocol. This session has been really driven by goods, the flow of goods post-Brexit, but a large number of questions came into us from attendees to touch on services. So I've just put up a slide or two on services. I'm not going to get into any real detail on cross-border services, but these slides that we have are really being prepared as a takeaway that I feel you'll find useful after the event to revert back to. And then I'll wrap up with some key Brexit takeaways, key distinctions, and also some considerations. So in a nutshell, what has changed? The UK has left the UK has left the EU. Brexit has happened, full stop. We're no longer talking about Brexit, we are in Brexit. It's the new reality that we're having to get used to. So with effect from 1 January 2021, the UK, excluding Northern Ireland, is a third country for the purpose of cross-border supplies of goods. We've got to start thinking of the UK as effectively a third country. It's exports and it's imports. And that's going to be a very important feature when we talk about moving goods from the Republic of Ireland. And when I talk about Ireland, I'm going to refer to Republic of Ireland. We talk about moving goods from the Republic of Ireland into the UK. That's an export. When we bring in goods from the UK, that's an import. Goods moving from Ireland to France, Ireland to Greece, Ireland to Germany, Ireland to Poland, they are still intra-community supplies and intra-community acquisitions. And there are subtle distinctions. So it's important we just get the mindsets. And then finally, Northern Ireland, it remains part of the EU customs zone. So this next slide that I have was sent to me, and I thought it was quite a useful slide because people get quite confused as to who's where, who's in what. And this slide very clearly graphically shows where the UK sits and also where Northern Ireland is and the Republic of Ireland. Republic of Ireland, as you can see, close to the centre of all of these customs territories, etc., simply sitting outside the Schengen Agreement. Northern Ireland there within the EU Customs Union, and the UK fully outside it. The Great Britain is fully outside the customs territory. So useful infographic for people that are confused as to where do we sit with things. So maybe the next slide. So definitions that we're looking at. Business to business, business to consumer, and they are very important for a lot of how we do business. There's different rules as to whether you're transferring to businesses, consumers. Domestic supplies, supplies of goods within within one member state or within a state, and that's quite important as well to determine: are you making a supply in Ireland? Are you making a supply cross-border? As I said, inter-community supplies of goods. The difference between imports and exports. It's important that people get that concept, how these move. So goods moving into the Eurozone is an importation, followed by free circulation within the European Union, and similarly with the exports. And then in the next slide, we'll come into concepts of reverse charge, self-accounting, place of supply, and you'll hear a lot of these terms, the INCO terms, international commercial terms, which are now critical. In the last 2 months, I've been hearing everything's been about INCO terms, DDP, DAP. What do they mean, and what are the terms of your trade with your suppliers? These will be very relevant from a UK VAT perspective, an Irish VAT perspective, and for customs. And depending on what your terms of trade are with your suppliers or with your customers, it puts the onus on clearing those goods through customs, accounting for the VAT at importation, and whether you're making a domestic supply afterwards. So it really is who's actually clearing it, who's taking the pain, for want of a better word. So maybe move on. So cross-border supply of goods. I've given here a table, just quite a useful table in the context. And again, I'm not going to go through this in detail. This is a useful takeaway as to when we're moving goods cross-border, what are the key territories? What are the key aspects that we need to think about? What we see there is the place of supply. The place of supply is critical from a VAT perspective because it determines where is VAT going to be accounted for, in which territory is the supply deemed to take place. Once we determine whether we're moving goods cross-border, is it a business customer or is it a consumer that we're transferring goods to? A lot of this session is in relation to B2B, business to business, cross-border supplies of goods between businesses. And again, we just need to be factor in. Once you've determined your structure or your supply chain and where you sit and where the place of supply is deemed to take place, the next question is as well, who is accountable for that VAT? In many instances, when we account for intra-community supplies of goods, so an Irish business supplying goods to a French business customer, the customer self-accounts for VAT on a reverse charge basis. Flip side is an Irish business bringing in goods from France will self-account for VAT. So those are key concepts. And this slide, I think, is useful for anyone in business trying to figure out, where do I actually account for VAT? Where am I required to register for VAT, or is it a self-accounting procedure, which simplifies matters? So maybe moving on, we have the cross-border supplies of goods, intra-community supply. So this is what everybody's been used to. Anybody who's been doing business with the UK, and majority of businesses in Ireland will do some form of business with at least the UK. So up until 31 December, it would have been intra-community supplies. Very, very simple. We had free circulation. Supplier does not have to register for VAT in the other EU jurisdiction. And on the invoice, there was effectively a 0 rating for the invoices, and the customer self-accounted for VAT on a reverse charge basis. Very, very simple process. So simple, in fact, that people weren't even probably aware that they were doing it. It was just taken for granted, this whole concept. So inter-community supplies will still apply in relation to Irish businesses doing business with the EU, all territories in the EU, and with Northern Ireland. So we now look at Irish businesses exporting goods to the UK, excluding Northern Ireland. So we're taking out Northern Ireland. It's important when we think about the UK now, as we think of 2 territories from a goods perspective: Northern Ireland and and Great Britain, I think, which is the England, Scotland, and Wales. So what we look at as we talk about exports from a VAT perspective is when you're exporting goods to non-business or customers or to private persons, to places of supplies where the transportation begins. From an Irish perspective, the VAT rate for an export is 0%. And exports are what we call a qualifying activity. No impact on VAT recoverability. So just because your business is exporting goods to the UK, you're still entitled to recover VAT from an Irish perspective, as if you were making taxable supplies. So the key questions really for you and your business, if you're exporting goods to the UK, is what are the terms of your trade? DDP versus DAP. And Wendy's going to touch on this from a UK perspective when she comes into it, because you always got to be considering the other side of the coin. So are you clearing the goods, or is your customer clearing the goods? Because that has implications as to how the VAT is accounted for and who is going to look after that clearances. So who's going to clear the goods into the UK? And that's where a lot of customs specialists, is it your logistics specialist? Is your customer going to accept the responsibility to clear those goods? Simplify things. If you're a customer in the UK, will clear those goods. They're registered for it. Makes very things simple. But there is paperwork and there is process. And in many instances, you'll see that you may have to clear those goods to maintain customer relationships. That customs declaration is required prior to and post export. That's key, is that when moving goods into the UK, you need to make sure your paperwork is in order. The last thing you want is goods being turned away because documentation has not been completed correctly. Then you got to consider, do you have to register for UK VAT? If it's a case that you're importing the goods into the UK and you're doing DDP, deliver duty paid, you may have to register for VAT in the UK. You might have to clear those goods in the UK, and then you may have to charge UK VAT to your customers, whereas previously this may have been a self-account by your business customer. And then again, can we get is there a cash flow implication for you registering for VAT and charging VAT in the UK? For example, is it postponed accounting, or who accounts for the VAT? So moving on, we will look at importation of goods from the UK. And again, it's very, very similar process. Where you purchase the goods from the outside the EU, VAT is applied at the point of importation. The rate that applies is the same as if you supplied those goods to yourself within Ireland. And again, you'll see those questions that I've asked. It's exactly the same. What are the Incoterms? Who is clearing those goods? Is it a UK business that's actually moving its own goods into Ireland to supply to customers, in which case they got to take responsibility for clearing those own goods? Are you buying goods from your customer? Are they going to clear those goods? Are you followed by this domestic supply? So you need to determine those terms of trades very carefully to figure out who is doing it, who is going to clear it, who is looking after that. And Brian is going to touch on that piece, that expertise that that has been lost within Ireland because people haven't been doing this. That's going to have to be relearned again, and getting assistance is very important. And then, as I said, import VAT or postponed accounting. So great, with effect from 1 January, we have postponed accounting for VAT. So if you're importing goods from the UK or from anywhere, but principally from the UK, make sure you're registered for postponed accounting. It's critical. It's a very easy process, and every importer should be registered for postponed accounting. It manages the cash flow. Moving on then, Deirdre. So Northern Ireland Protocol, myself and Wendy tossed us around as to who was going to deal with Northern Ireland, the hot potato. But in reality, both parties, both ourselves and the UK, have to consider the process, how goods are being dealt with. I've been asked questions from UK businesses about how do I do business in Northern Ireland. I've been asked questions about Irish businesses. What's the situation with Northern Ireland? In reality, Northern Ireland remains subject to the same VAT rules as an EU member state. So supply and movement of goods between Northern Ireland and Republic of Ireland, their direction is unchanged. So you almost got to think about Northern Ireland as part of the EU simply for the movement of goods. So the reporting obligations for those goods transactions are remaining the same, VAs and intra-stat reporting. So it's a much more simpler process if you actually can think of Northern Ireland as being part of the EU. So even when you're transferring or moving goods into Northern Ireland from the Republic of Ireland, those are effectively intra-community supplies and acquisitions. And Wendy will touch on from a UK perspective. This process is to be reviewed after 4 years. That's if things don't change in the interim, and I wouldn't be surprised if there are some tweaks or some changes to this to bed it down, because as we all know, there are problems in the working of the protocol. So for foreign traders, no establishment in Ireland. So this is in the context of a lot of UK businesses coming into Ireland. If you're not established, there's no but you're supplying goods in Ireland, there is no threshold for supplies of goods. You've got to register for VAT. You need to determine, are you supplying goods? Are you clearing goods and then selling to your customers? So in many instances, there's registration requirements for those foreign businesses, and Irish Revenue are doing more due diligence in giving VAT registrations to foreign traders, to UK businesses. They're asking more questions, and in particular, they're now specifically asking about contracts and supply terms. What are the Incoterms in respect of your supplies to your customers? So it's important that you have those in place and you effectively are able to answer those questions from the outset. Moving on then, Deirdre. So again, here's just a simple example. No establishment with a UK business importing its own goods and holding them in stock in an Irish warehouse. So what we have is an importation of goods brought into the EU by the business. They're their own goods. They're stored in the UK. So that's an importation. The UK business has to register, has to account for the VAT. They're entitled to obtain postponed accounting. And then when they fulfill orders with Irish customers out of that stock of goods in Ireland, that's a domestic supply from an Irish perspective, and they've got to charge Irish VAT. And that's quite common for many UK businesses that want to maintain relationships with their customers. And moving on then, cross-border supply of services. Similarly, again, it is key to say that the key piece is that Northern Ireland is part of the UK for services. So, for example, when we're talking about the Northern Ireland Protocol, it only applies to goods. So again, services, it's a much easier process. Are you supplying services to an Irish, to a UK business or a UK customer or personal? It's zero rate. If you're receiving them from abroad, it's self-account. A very, very simple process. And I'm not talking about the financial services, regulated services, but majority of services, very, very straightforward. Very little has actually changed from a pure VAT perspective. Moving on, Deirdre. Again, I think we'll just move past that one. I think if anybody's any questions, I can come back to that. I can come back to that again in due course. So what are the key Brexit takeaways? I mean, the key thing from coming out of this is to distinguish import and exports versus intra-community supply. Those are the key terminologies. When you're dealing with the UK, it's imports, exports. It is fundamentally different from intra-communities. Particular rules for Northern Ireland, you need to know the distinction for goods and services. I think Northern Ireland is intra-community supplies for goods, but for services, it's the UK. Importing of your own goods, moving goods from the UK into your own stock in Ireland is an importation, and vice versa. I presume moving your own goods into the UK is an importation. The Incoterms are critical for VAT and for customs. Make sure you're registered for postponed accounting. We'll see the first VAT returns for January, February being filed this month. So you'll see the new box in the VAT return which captures the information for VAT for postponed accounting. Reliefs such as triangulation and call of stock, they're no longer available for the UK. And when I say UK, I'm talking about Great Britain here. So those particular reliefs that we were all used to are no longer relevant. VAs and intrastat returns are not required in respect of goods, movements of goods with the mainland of the UK. Moving on, and then key considerations. What you have to do is you've got to review your supply chain. There's no one size fits all. I've dealt with many customers, many businesses, and everyone has a unique nuance that needs to be addressed. Commerciality. Where is the balance of power? Was DAP maybe optimal for a supplier? Listen, it's over. You're passing the buck on to your customer. Sort it out. If the customer is part of that customer relationship is important, they will push for DDP, and you got to be ready for it. Opportunities. I've been talking to some clients who feel that with Brexit, what will happen is these challenges and obstacles are going to be challenges and obstacles for all of your competitors. So whoever is able to grasp it and whoever is able to come up with a solution is going to develop and generate market share. So there is opportunities for those who are able to invest in it, and just be aware of positive changes coming down the tracks in relation to the distance sales from 1 January 2021 and the extension of the mini one-stop shop. That's in the context of cross-border distance selling within the EU. So we will have, there'll be a lot of positive news in relation to that in due course. So I think that's my just a whistle-stop tour of Irish VAT. Wendy will pick up on the UK side, obviously, and the nuances from a UK VAT perspective. Thank you.
Wendy, just before you kick off, can I just remind everybody that at the end of this session, we will be having a Q&A session, and in the middle of people's presentations, feel free to ask questions, type a question in the Q&A facility that you'll be able to find at the bottom of the Zoom window. Wendy, over to you.
Thanks very much, Chris, and thanks very much, Ronan. Ronan's given a really comprehensive overview, really from both perspectives of what trade between the UK and Ireland looks like since the 1st of January 2021. So what I thought I'd do is just pick on three sort of key areas which are problematic and explain some of a bit more information from the UK stroke GB side, and having to use those expressions quite carefully. When we're talking about the UK from a legal perspective, it's the UK. But as Ronan explained, when we're talking about movements of goods in particular, we have to make a distinction between GB, which is England, Scotland and Wales, and Northern Ireland. As Ronan explained, the Northern Ireland remains part of the EU for goods transaction purposes. So that does make things a bit complicated. I have to be quite careful to think about what terms I'm using to describe the country. So I'll try to do that as I go through. And to start with, I just thought I'd talk about a few issues on the GB side in terms of importing goods. Because obviously the big principle that we're kind of grappling with since the 1st of January is the fact that on that day, a customs border sort of descended into the Irish Sea, I guess. And all transactions in goods between Ireland and GB need to go through customs processes, and that includes some VAT implications. And the first issue, which as Ronan has been, I've been dealing with lots of businesses about since the 1st of January, is this question of Incoterms. When we were all in the EU single market and customs union together, no one was too worried about what the Incoterms were for a transaction, because it would pass it wouldn't need to cross a customs border, no declarations would be required, didn't really matter whether it was ex-works, FCA, DDP, DAP, all fairly straightforward. And that is really what's been thrown into relief by Brexit since the 1st of January, is people needing to analyse their supply chains in much more detail, and in particular establish who's responsible for an export declaration and who's responsible for an import declaration. And the big problem area, again, as Ronan highlighted, but just looking at it from a GB perspective, is where your Incoterms are DDP. Because if you're an Irish business and you're selling some goods to a GB customer and your delivery terms are DDP, you're responsible for the importation into the UK, making the UK GB, I suppose, import declaration, paying import VAT and paying any customs duty that might be due. And the main knock-on implication of that is that you will probably need a UK VAT registration in order to do that, in order to reclaim or postpone the VAT that's due on the importation, and to be able to account for VAT on your sale to your UK customer. So I think that's slightly unforeseen, I think, not really anticipated it would be such a huge issue, but it has become clear that, as Ronan said, people have had to look at their commercial relationships quite carefully to work out, commercially who wanted to be responsible for the import declaration, or in the commercial relationship how that responsibility kind of manifested itself. So that's been a significant issue, and is definitely still one that people are struggling with. Some things a little bit easier on the GB side from a customs perspective. I'm sure Brian will pick up on this later, but in terms of goods coming into GB, customs authorities there are some reliefs. There's a 6-month delay potentially in making a full customs declaration, and some of the food inspection processes, etc., haven't been introduced yet, and will be introduced gradually between April and July this year. So probably a few more complications to look forward to on that front over the next few months. And one piece of good news from a GB perspective is a change in the treatment of import VAT in GB, because we've introduced from the 1st of January postponed accounting for import VAT, both for imports from the EU and actually from imports from all around the world as well, which means that businesses no longer have to pay import VAT effectively upfront in cash and then reclaim it on their next VAT return, as long as the appropriate declarations are made when the import declaration's done. The VAT can be postponed by UK VAT registered businesses and then accounted for on their VAT return. But it's that UK VAT registered businesses condition which is important, because if you have accidentally got caught up in some kind of DDP transaction and you don't have a UK VAT registration yet, you won't be able to use postponed accounting. So one of the disadvantages will be you'll have to pay the import VAT up front in order to get the goods through customs. So just to reiterate, because I'd kind of assumed that would be obvious to everyone would start using postponed accounting immediately, but it's become clear that shippers, customs agents, etc., aren't necessarily asking for postponed accounting to be used for VAT on customs declarations. So if you are importing into the UK, really important to make sure whoever's doing your import declarations is aware of the need to sort of claim postponed accounting when they're doing the documents. Okay, so a few points there on importing goods into GB. Secondly, I wanted to talk about some changes in the way business to consumer sales are treated for UK/GB customers after the 1st of January. I'm going to look at two aspects, goods and services, hence why I've put UK and GB. For sales of goods to consumer customers, we're looking at rules which apply only to GB, because Northern Ireland continues to be in the EU for goods purposes. But for services purposes, it's Northern Ireland as well, so it's the UK. Two different new regimes, the same in principle. So first of all, talking about supplies of goods to consumer customers, so typically online retail sales to consumer customers in England, Scotland and Wales. And it's a slightly confused picture there, I have to say. HMRC, the government, announced that from the 1st of January, any businesses sending in goods, delivering goods to GB consumers, which were less than £135 in value, anyone doing those kind of transactions would need to register for UK VAT and charge UK VAT on those sales. That's what the rules say. In practice, I think the position is a lot more complicated. I think a lot of non-GB based internet retailers, etc., are simply not selling to GB customers. Some businesses have done the VAT registration and are accounting for VAT. And there's some evidence that some other retailers selling to GB consumers are just sending goods in without having paid the VAT on them, and that then knocks on and the customer has to pay the VAT. So quite a complicated situation there. If you are a non-GB based retailer selling into GB consumers, I think the easiest thing to do is to get a UK VAT registration, because you can then collect the VAT from your customer, pay it over to HMRC, and the parcel can be delivered to the consumer with no disruption. But as I say, it doesn't seem to be a very clear picture at the moment. So the other B2C area I wanted to look at is around supplies of services. Because if you're an EU-based supplier, for example, of some kind of electronic service to consumer customers, apps, ebooks, etc., The UK will previously been part of your mini one-stop shop VAT registration, and you will have accounted for VAT on your sales to UK consumers through that mechanism. Since the 1st of January, the UK isn't part of that mini one-stop shop registration. So if you continue to sell electronic goods, electronic downloads, etc. to UK consumers, you will need a separate UK VAT registration. And that's not a mini one-stop shop or anything. It's a simple UK VAT registration because you're just accounting for VAT on your sales to UK consumers through that. So that's probably quite an important one to remember if you've got quite a complex operation that you have to pull out now your UK sales, and you'll have to account for VAT on those through a different route, through a UK VAT registration. And then the last area I just wanted to look at was around goods movements between GB and Northern Ireland. That's obviously become an extremely complex area. So I'm going to just describe the two simplest transactions, because anything more complicated, I think, probably does need some quite detailed advice. So, for example, the two transactions I'm going to talk about, first of all, a simple sale of goods from a GB supplier to a Northern Ireland customer. And that is actually dealt with in the same way as it would always have been, with UK VAT being charged by the GB supplier and then that VAT being recovered by the Northern Ireland customer. So relatively straightforward. A big change, though, and one which businesses do need to be aware of, is the movement of your own goods between GB and Northern Ireland. Typically, there would usually have been no VAT accounting required on the movement of your own goods within the UK. But now, of course, those goods need to cross a customs border in the Irish Sea before they arrive in Northern Ireland. And to make sure that the VAT side of that is dealt with properly, what has to happen is that as the GB supplier, you charge VAT, account for VAT, output VAT, despite it being a movement of your own goods rather than a supply. And then on the basis that those goods then arrive in Northern Ireland and are going to be used in your taxable business, you can then reclaim the output VAT you charged yourself as input VAT. So it's effectively reverse charge type VAT accounting, but very important to get it right. And there are some special rules around how that works if you're using something like customs warehousing or some kind of customs process around the goods. So important to be aware of that. As I say, quite a lot more complicated provisions around goods transiting through Northern Ireland, etc., which need probably specific advice. The UK government has set up what's called a trader support service with the aim of providing sort of targeted support to businesses trading in Northern Ireland. So that probably should be the first port of call for more detailed advice on how those transactions will work. And I think that's just about all I had to say on the UK side of things. So I'll hand over to Brian McMurrough from SwiftFile.
Thank you, Wendy. Move on to the next slide there, Deirdre. Look, I think the guys have pretty well sort of set the scene as to where we are. From a customs point of view, we're in fairly good shape on an overall basis. We haven't seen the chaos that some had predicted around major snarl-ups in the ports. But where we are seeing difficulties is on a micro level, on a company-specific level. Some companies are really struggling. Some companies are faring up okay, and some companies, the sort of custom solutions that they've put in place aren't really fit for purpose. So like with anything, and I think Ronan touched on this, it's businesses that adapt best will survive and will prosper. In terms of what we're going to cover today, I'm conscious of the fact that an awful lot of the customs concepts are a little bit new to a lot of people. So we've only got 15 minutes, so I can't go too broad and I can't go into too much detail. So what I've done is over the past couple of months, I've noticed issues and risks and trends emerging. And so I've identified probably 4 or 5 of the sort of key risks that I feel companies should be switched onto. And I've suggested some solutions, practical solutions that you might find useful if you are faced with those challenges. And then we might even look at a couple of opportunities as to how companies can take the sort of sting out of the customs tail. So just very briefly, this is what we're going to cover. I mean, the first four are the challenges that I'll highlight and give you a few details on. I'll touch briefly on the North. I know the two guys have spoken about the North, but I'll touch on that from a customs point of view. And then at the bottom, there's just a couple of simplifications as to how we can, again, the opportunities to how to sort of minimize the impact of customs. The big thing that I've been seeing over the last couple of months is that all of the focus is on, number one, keeping goods moving, and number two, minimizing duty paid. And look, that's perfectly understandable from an operations point of view, but companies really need to get switched on to the importance of staying compliant and what they need to do from a compliance point of view. Because ultimately, I mean, you can outsource the declaration filing to an agent or to a freight company, but ultimately customs compliance is the responsibility of the trader. And any non-compliance or any errors, excuse me, or any under declarations, the company is on the hook. And with e-declarations, the right combination of characters in the right boxes will get you a green routing, but it doesn't necessarily mean that the declaration is right. So businesses really need to be conscious of the compliance requirements that they have to face. In terms of how to overcome this, it's really a case of changing the mentality. So businesses need to think of a customs declaration in the same way as they think of a VAT return or a POA return. And because non-compliance around customs is just as serious and potentially expensive as non-compliance around any of the other taxes. So in terms of what people can do, it's really a case of taking ownership of your customs declarations. So companies should look for full visibility. Again, look, in a lot of cases, it will be third parties doing the filings. So whether it's a customs agent or your freight company, you should look for visibility about what's been filed in your name and then carry out regular customs audits. Now, I'm not talking about full bells and whistles audits, but even spot checks, like on a monthly basis, 5 or 10 declarations are pulled and tied back to backup documentation. So again, it's just a case of getting switched on to the customs compliance requirements, just to minimize the opportunity or minimize the risk of any problems down the line. Because again, I think people have just been focusing on firing stuff through, but at some point you need to raise the head and look at the compliance to make sure there's no serious problems for your business down the line. Second issue isn't just keeping goods moving. So you can see the numbers there from the revenue, 1.8 million declarations in January alone versus I think 1.6 million in the whole of 2020. So it's a big uplift. And 75% move fairly freely, but then you're still talking about 450,000 which were held up in port. Now, there's not an awful lot you can do in the short term to sort of minimize the chance of your shipment being pulled for inspection. But what really sort of is an important thing is incomplete paperwork can slow it down getting moving again. So if you have a commercial invoice and it doesn't have sufficient information for customs, it gets pulled by customs, customs goes back to your agent, they go back to yourself, you have to get onto your supplier, and there's a frantic cycle trying to pull together a sufficient document in order to get your goods moving again. So that sort of exacerbates the slowdown of goods, the lack of documentation. And then, thanks, Deirdre. And then in addition to that, there's also slowdowns all over Britain and Ireland and offices and warehouses. Basically, people aren't switched onto it, not switched onto the data requirements. The guys touched on Incoterms. So all points in the supply chain, there's a potential to slow down. So if there's a slowdown, supplier, customer, agent, haulier, ferry company, any slowdowns anywhere along there, things get held up. Next slide, so please, Deirdre. In terms of what you can do, look, there's 3 critical factors to keep things moving: data, documentation, and communication. If you get those things right, you're going to be in good shape. Data is massively important, and if your data is not right, your goods won't move. So get that right at the front end, have your full suite of product data, transport data, and company data, and get that to whoever's filing on a timely basis. I mentioned the slowdown piece around the commercial invoice. Sit down with your supplier and just make sure you have a full suite of customs information on your invoice. There's probably about 5 or 6 pieces of data that might not be on an ordinary invoice that's required for customs, I've listed them there, commodity code then to package type. Just make sure they're on your document. Then if it is pulled, you can get things going quicker. And then the last one is communications. Make sure everyone has their roles and responsibility, and put processes in place for the introduction of customs. And then once you got your process in place, things will move easier, and you're not going to get snarled up with massive sort of admin requirements. Third sort of challenge that I've noticed is around the trade agreement and origin. So once the trade agreement was signed, origin becomes a massively important concept, and it's a massively complex concept. So there's a whole series of rules around origin. There's general rules, and then there's product specific rules. And the key thing to remember is under the trade agreement, it's only UK or EU origin goods that are entitled to preferential tariffs. Nothing else should be claimed 0% tariffs. So it's hugely important, the whole concept of origin now at this stage. So I just wanted to give you a couple of examples to try and paint a picture as to the sort of rules of the game. The first example, a Chinese origin product coming into the UK from Ireland, coming into Ireland from the UK, it remains a Chinese product and it will be subject to duties. So that's fairly straightforward. But if that same Chinese product was worked to a sufficient degree in the UK, it could acquire UK origin. And then in which case it could come into Ireland duty free. But again, it has to satisfy a whole series of rules of origin. And the third example is of a German product that moves to the UK, it's not processed, and it moves into Ireland. So that product will be subject to duty. Now that's something that might surprise a lot of people, but it's a standard provision in trade agreements. And I think part of the issue is that trade agreements are typically involving jurisdictions with quite a big geographical spread. So Canada to the EU, Vietnam to the EU, it's very unlikely that goods are going to be bounced back between those two jurisdictions. But because we're so tight and we're so close here, it does happen. But so I see this has been a real sort of challenge that businesses are going to have to overcome, just given the interconnectedness of the supply chains. And around origin, there's no sort of easy option on this. It's just a case of getting comfortable with the concepts, comfortable with the rules of origin and how it affects your business. So you just need to get a clear picture of the origin of your businesses, the origin of your products. And if you are claiming preferential rates, you have to be able to prove that that you're able to, based on the origin of the goods. Any businesses with relatively complex supply chains, you should map out the supply chains and identify the duty hits. Where are the duty hits in the supply chain? Okay, and then what can we do to minimize it? You might be able to claim preferential origin, or in the absence of that, you might look at alternative means of travel or alternative products with preferential origin. But one point down the bottom is important to make is around that example 3 that I gave in the last slide. There's a concept called return goods relief. And that's when products have left the EU into the UK and then re-imported back into the EU. So it is possible in that instance for companies to claim return goods relief, where you can claim back the duty paid. But again, there are certain conditions there you need to avail of. But I think that's going to be a big benefit to companies, and companies need to be looking at that relief. Excuse me. Sort of connected to origin is the actual claiming of preferential rates. So some of the things I've heard over the last couple of months, my supplier said I should be okay, or my agent say he should get it through, or I believe we have a trade agreement with Indonesia, which we don't. The onus is on the importer to make sure that they're entitled to preferential rates. And that's hugely important. You can't be claiming preferential rates if there's no entitlement. The example I gave there, that particular company, they were bringing in one shipment a week worth about €20,000. They should have been paying 5% rate, but they were claiming 0% rate. Now, if that continued for the year, that's 50 grand's worth of underdeclared duties. So it's massively important that businesses aren't claiming this, and this is an area that massively risks the whole compliance piece of underdeclaring duty, and it could lead to problems down the line. Next slide, please, Deirdre, if you don't mind. And then just the solution piece on this is, how can you rightfully claim preferential tariff rates? How can you get comfort that you're doing it? Well, the first protocol is to make a declaration make a claim in your import declaration. The second point is you have to have proof of origin at the time of shipment, at the time of entry. And the most simple way of doing that is to get a statement on origin from your supplier. And then you have to keep records for 4 years, and you could be subject to inspection up to 4 years down the line. So again, you have to know if you're claiming 0% tariff, you have to know you're entitled to it, and you have to prove you're entitled to it. But I think the last point on that is preferential rates can be claimed retrospectively, so up to 3 years. So again, if there's any doubt about whether you're entitled to claim or not, just err on the side of caution, and you can claim after the event. So they're the four sort of main challenges that I've seen. Just a brief slide on the north. The guys have touched on this. It's hugely complex, and the practicalities are still been ironed out, and it's really down to the fact that it was only agreed at the 11th hour. But I think the important thing is it's a totally separate set of declarations. And at the moment, into the north, GB into NI, there are simplified declarations, but by this week, companies are having to file supplementary declarations on a monthly basis. And then there's further beefed up checks from April. But the key thing is on this, the default position is that there are duties payable on goods moving in. Now, it's possible for businesses to claim them back or to claim relief if they can prove the goods remain in the north. But as I said, the default position is there is duties. So it can't be a sort of a backdoor into ROI and into the EU on a duty-free basis. Okay, so there really the sort of risks and challenges I highlighted. It's around compliance, it's around keeping things moving, and then it's around the whole origin preferential tariff rates. So we just look at a couple of things now. So customs special procedures, simplifications, trade facilitations, there's several different names to them, but what they are is they're sort of allowances that tax authorities have put in place to streamline operating in a customs environment. It makes it easier for businesses, it saves them money, it saves them time, and it reduces red tape. There's over 20 simplifications in total, and there's something similar in in the UK, and in the States, and in most jurisdictions, they have these sort of simplifications. So I'm just going to touch on a couple of them to give you a bit of a flavor. I mean, the first one is temporary admission. And that's if you're bringing something in on a temporary basis, you can get relief from duties. So examples of this is maybe bringing racehorses over to Cheltenham next month, or music equipment or construction equipment coming in on a temporary basis. But the key points here is the goods can't be altered in any way. They have to be in the same condition when they're leaving as when they entered. And the max period of admission is for 2 years. The second word is inward processing, which is slightly different because businesses are allowed to change the products if they're brought in for a specific purpose. Now, an example of this might be an Irish customer who bought product from a UK supplier and they send them back to be repaired. So that movement back to GB and back across to ROI, there can be a suspension of duty on those products. And there's also instances where it can be brought in for specific purposes and there can be a suspension of duty. And the third one is just the use of customs warehouse. Now, historically, customs warehouses were bonded warehouses for alcohol and tobacco, but now there's a facility whereby companies can have a part of their own warehouse carved out to be a customs warehouse. And there's huge benefits there for businesses that are moving. And that might be a GB business that's moving product into GB and then on to Ireland. So there can be a suspension of duties there, which again can be hugely beneficial. So these special procedures can be used either in isolation or a combination of one or two to make life easy for businesses. Thanks, Deirdre. Just in order, how do you avail of these? An application needs to be submitted and your business needs to be authorized. You need to demonstrate compliance because there is an element of trust been given by the tax authority. And a business needs to prove that there's a need and a benefit to it. And in some instances whereby duty has been asked to be suspended or relieved, a financial guarantee is required. And this is usually put in place through a bank. but I do know that there are grants available. I know the Department of Taoiseach in Ireland has put in place a fund to fund the guarantee around transit to make it easier for businesses to transit goods through the UK. So that's something certainly businesses should look into. But that's the special procedures. The benefits are there. There's cash flow benefits, P&L benefits, and then it reduces admin and it increases speeds. So it's certainly something that businesses should look at. Regardless of the type of trading business you have, there should be a special procedure that you can avail of. And if you don't at least look into these things, you're leaving something on the table, because there's real benefits there. And just a last slide on AEO. You might have heard a little bit about AEO because it's getting a bit more prominent now. We're slightly behind the curve in the take-up for this in Ireland, but it's essentially the EU Trusted Trader Programme. And there's similar programs in the UK and in the States and around the world. And again, it's like an umbrella program for companies to avail of simplifications and to ease the burden of operating in a customs environment. There's a whole host of benefits, and again, it depends on the nature of your business, but there are benefits for all businesses. But I've just highlighted one there, which is called EIDR, and there's huge benefits for that, particularly companies that are at the sharp end of Brexit, that are really feeling the effects of customs, maybe like a high volume transactions or very short supply chains, because that allows businesses to push declarations back away from the time of shipment. So there's no upfront declarations. So almost that allows businesses to push customs back to being part of like the month-end process. So again, huge benefits there. So AEO, I just touched on that EIDR, but there's an awful lot of benefits there. And again, it's a case of putting in an application and demonstrating customs compliance, financial solvency, and just strong systems and processes. But it's certainly something businesses should look at availing of. And just to end, look, I've highlighted some of the challenges and some suggested some solutions, but I suppose the end goal in terms of where you want to get to is that you've weathered the customs storm, that you got comfort around your compliance piece, and you're reducing costs by claiming preferential duty, rightfully claiming preferential rates, and then if you're in a position where you've minimized admin costs by putting in processes around the customs and you're taking full advantage of special procedures, that will get you back. Look, I think we're going to look back at the pre-2021 phase period with fondness, because it really was seamless trading. So we're never going to get back to that. But by taking these steps, you'll take the sting out of customs and you'll be in good shape, and a lot of other businesses who won't do that and won't be in a position to do that and will continue to try and muddle on. But if you can take those steps, you should be in good shape. So I hope that gave you a sort of a flavour of where we are and what you can do. And look, if you need any, we're doing a Q&A now, but if you need any more details, please get in touch, and I'll give you a steer if I can.
Brian, thank you very much. It was really positive to see at the end of your presentation, Brian, that you were talking about potential opportunities and solutions. It's imperative that we try and find a way through this regulatory mess. Just looking back at some of the figures, in 2019, the UK exports to Ireland were worth about 40 billion, and from Ireland to the UK, about 30 billion. And Ireland represents the UK's 5th largest export market, and correspondingly, as a CEO said to me recently, the UK market of about 70 million people is a big market, and you've got to have a good reason to step over it. So we do need to find solutions. Hopefully answering some of these questions might go some way to finding those solutions. So we'll get through as many as we can. We were due to finish about 9:30. I think it'd be okay if we run over slightly. We will be sharing the slides and contact details, so we can endeavour to connect with you afterwards to answer any questions and challenges that you're facing that we don't get to in the questions. So I'm going to kick off with a question that hasn't actually been asked specifically. It's been covered in a number of the questions that we've had. I'm going to put this one to Wendy to start with. And it's also a question, an area that's come up this morning in the presentations and was submitted to us as a question before this morning, which is, how precisely does postponed accounting work, and what are the specific steps required to set it in motion? Wendy, can I come to you on that first, please?
Yes, thanks, Chris. And I think I probably need to go to Ronan as well, because I think we've got two different postponed VAT accounting regimes, one in the UK and one in Ireland. So yes, as I explained earlier, you can apply for postponed accounting for import VAT for goods arriving in, I guess, GB, by asking for postponed accounting to be used when you do your customs import declaration, only available, as I say, to UK VAT registered businesses. Once you've done that, you should then receive a report from HMRC showing how much import VAT has been postponed in a period. And then when you come to do your UK VAT return, you account for that as that import VAT as output VAT, so paying it over, and then you claim it back as input VAT, claiming it back in full if it relates directly to taxable supplies you're making in the UK, or restricting it if you're partly exempt or otherwise unable to reclaim all your input VAT in the UK. Generally, though, for most businesses, it will just be a straight output VAT and input VAT claim. So straightforward. But I think Ronan mentioned there's a special new box on the Irish VAT return. On the UK VAT return, no new boxes. It just goes into the normal output VAT and input VAT. So box 1 and box 4 of the UK VAT return.
Yeah, and maybe Chris, just to pick up that from an Irish perspective, so anybody who was registered who had an EORI number at 31 December automatically was rolled into postponed accounting, and from an Irish perspective, we're able to avail of postponed accounting. Any new businesses being set up, foreign traders, etc., there's a box in the new tax registration forms to effectively to register for postponed accounting. The first VAT returns, January, February, being filed this month. So within the VAT returns, similar to what Wendy said, you'll put it on your what we call T1 and T2, which is your input and output VAT, the self accounting for the VAT, and then there's a new box to capture the amount of VAT that's been, that has been effectively postponed accounting.
Brilliant. Thank you, Ronan. One for Brian here. Where can I find a more complete listing for commodity codes? Tarek's site does not include codes for equipment we supply into the UK.
I mean, the Tarek website should have it all. I don't think if it's not on Tarek, you need to find a classification. I mean, there's over 10,000 classifications on Tarek, so it's a case of finding the one that most closely describes your product. But it has to be on that. That's all encompassing.
Okay, thanks, Brian. And another one for you. I'm an Irish company. Do you need to be established in the UK to do an import declaration?
So just to make a distinction, to actually file the declaration, you do. So to file a declaration, an import declaration into the UK, you would need a UK entity. But if it's a case whereby you're going to use an agent to file that import declaration, you don't necessarily need to have a company set up, but you do need a GB or a UK EORI number. So I suppose if you're actually filing the declaration yourself, it's more onerous and you need to have a company. But if you're going to use a third party to do it for you, well, then your Irish entity can apply for a GB EORI number.
Brilliant. Thanks, Brian. We've been wrestling with VAT and duty this morning. The one thing we haven't really mentioned is foreign currency. We've got an excellent question here that adds another layer of complexity onto it. So I'll ask the question and then I'll let one of the panel jump in and answer it. A question from James. I have a question about VAT postponement. I buy in euros, but I'm invoiced in dollars or sterling. Do I value the goods at the euro value I paid? E.g., I buy goods for $12,000 but pay 10,000. Do I put on invoice at 10,000 euros? As before on import, the goods used to be valued by forwarder based on exchange rates. So how do we factor how people pay and the value in the different currencies into our compliance? Who'd like to pick up on that one?
So certainly from a UK perspective, I think the UK import VAT that was being postponed would be based on the customs valuation. So you would have in sterling, I guess, the the commercial invoice translation that was being used for the customs declaration, and that would be the value on which the input, because import VAT is treated as a customs duty, so it's calculated on the local currency value of the importation, I think.
Okay.
And the tax authorities would have their own FX rates. Yeah.
Okay. Next up, Irish company sends goods to a UK company for repair. UK company repairs goods in UK and then sends back to Irish co. The repair goods are not for resale. What are the implications on this from a VAT and customs perspective? Ronan, do you want to kick off with a view on that one? And maybe Brian, if there's a burning customs element to that.
Well, moving the goods from Ireland, own goods, into the UK. So I think you've got an exportation of goods from Ireland to the UK, moving those in. And again, I would have thought then from a UK perspective, there's some form of a corresponding importation of the products into the UK. And then when the goods come back into Ireland, you'd have another importation. But if you're postponed accounting, there should be no VAT cost as such. I think it's more in the context of the actual customs that may be relevant as to the importation duties, where Brian actually touched on, I think, some of the reliefs that might apply in that context. Brian, the inward processing relief or whatever.
Yeah, that's what it'd be. It'd be a case of putting in an application for inward processing to suspend the duty.
Okay. We've got one here on services. Please, can you explain the process again of providing a service to a Northern Ireland company? We look after digital marketing for a Northern Ireland company. Do we now have to charge VAT?
I presume that's an Irish company, a Republic of Ireland company providing services to a UK company. So I work on that basis. If that's the way it is effectively a zero-rated invoice. There's no charge to VAT. Beforehand, it would have been an intercommunity supply of a service, Ireland to the UK, and it would have been necessary for the Irish business to get the VAT number of the recipient in the UK and to put on the invoice, reverse charge applies. Now this would be a service outside the EU at zero VAT. Irish business is still entitled to recover VAT in full in respect of its cost, because it is, although it's not a supply of service within Ireland, it's a qualifying activity.
Brilliant. Thanks, Ronan. Where do you get a customs declaration statement from for both UK imports, exports and Irish imports, exports? Should these be available on Revenue HMRC online portals? Brian, what's your take on that?
Sorry, what is it, Chris?
Where do you get a customs declaration statement from for both UK imports and exports? So I'm, in terms of actually getting these forms, the protocols, the procedures, where can people go to get the necessary forms?
Yeah, certainly. I mean, the Irish Revenue, revenue.ie, as a very complete website, and on the GB site, HMRC has a complete website. So there's a whole host of information on that companies can draw on. But if it's a statement, like possibly an activity statement is a question. I mean, certainly in Ireland, the revenue will send a statement of transactions on a weekly basis, on a monthly basis. So companies can see the transactions that have been filed in their name, the import and export transactions. So if that's the question, that's possibly alluding to monthly reporting, and to be able to join the dots between what you're filing and what the duties are and what the import VAT position is, there will be monthly statements sent out.
Yeah, and I think it would be the same in the UK. You don't have to go and find it. It should be sent to you if your details have been used in the declarations.
Brilliant. We've still got nearly 250 people still desperate for answers, so I'm going to just keep asking a few more questions, even though we are running over slightly. So the next one, an interesting one here, probably one for you, Brian, in the first instance. I'm also wondering about this scenario. We put stock into a company last year on impress stock. If we go to take these goods back, do we then have to pay VAT and duties on import, even though we paid duty on import originally from China?
So that was stock that was moved prior to Brexit Day, for want of a better word, prior to the the 1st of January.
Yes, it would appear so based on the wording in the question. Yeah.
And it was moved from
China. So we put stock into company last year, Empress stock. Originally imported from China, duty paid. That would have been pre January 21.
Yeah.
If we go to take these goods back, do we then have to pay VAT and duties on import, even though we paid duty on import originally from China?
Absolutely, yeah. Yeah. So again, it's still a Chinese good, so it won't qualify for any sort of preferential rates.
Fantastic. Well, it was a very simple answer to a very long and complex question.
it took me a while to get my head around it. So hopefully I didn't get the wrong end of the stick, but there you go.
Well, if you did, and the person asking that question needs further follow-up, we will be sharing follow-up details. I'm probably going to just run with about 2 more questions and then we'll wrap up. How does an Irish trader importing goods from, say, England apply for post-accounting for VAT? Is it just a matter of inserting this in the new box on the return? And I want to blend that with another question, because I think postponed accounting is clearly very important, the questions. So again, on that compliance bit, and Wendy will go to you. And crucially, what are the pros and cons versus payment at point of entry? I.e., is postponed accounting always worth it if you're going to go through that application process?
Okay, so to obtain postponed accounting for a non-established trader, so obviously that trader is moving goods to Ireland. So what we would have there is they're either moving their own goods in, or else they're supplying goods DDP, such that they're actually clearing the goods into Ireland. They will require an Irish VAT registration. So there's a form TR2FT, which is a tax registration foreign trader form, specifically for non-established businesses looking for a tax number. Within that form, they can register for VAT in the Republic of Ireland. And when you're registering for VAT on that form, there's an application to obtain EORI number and effectively postponed accounting. So as part of the process of registering and obtaining a tax number and VAT number in Ireland, I would make sure you check that box, because you want to get your postponed accounting. If you're registered for tax VAT pre Brexit, so for example, if you hadn't established, if you were registered anyway in Ireland, I would just check that you have an EORI number. If you're registered for EORI, you would automatically be registered for postponed accounting. And then whenever you're actually doing the declaration, or whenever you're doing your VAT return, you should have the details of all those goods that you've moved in. You put it on the box. It'll be T1, T2, and then there's a third new box in the postponed accounting that's returned on. So that's the process. As I said, we'll see a lot of those filings this month. This will be the very first month. So I'm sure there'll be a lot of people looking for assistance in filling out those forms. As regards the benefits or the pros and cons, Chris, I don't see any cons, to be honest with you, because all you're doing here is if you didn't have postponed accounting, you would have to actually pay the VAT to release it from store, from customs. So you'd be out of pocket getting those goods moving. So and then you'd be effectively putting on your VAT return and claiming a refund of VAT. Anyone knows, dealing with the Irish revenue, getting refunds of VAT, the hoops that have them. I'm not sure what's like in the HMRC, but the hoops to go through to get a VAT refund. So even though you're filing VAT returns every 2 months, if you're actually looking for a check, it can be very, very difficult, and the amount of questions. This allows you effectively as close as possible to maintain the status quo, which was reverse accounting. So for me, it's all positives. It's taken VAT off the issue. So the big issue I can say to clients is that if you're registered and getting postponed accounting, what you got to do is manage your duty. If you can get zero duty, and if you can get effectively postponed accounting, you're in a pretty good shape. We're never going to be in the same position as we were pre-Brexit. But what you've done there is manage those particular additional costs. There's more red tape and there's more compliance, but that's a good result in the current environment.
Okay. Thanks, Ronan. Conscious of time, I'm going to go with one last question, and it's the old favourite of freight. And it seems the number of stakeholders in this question probably points to Brian, because it seems similar to one of the examples that he used in his presentation. So the question is, I operate a freight company dealing mainly with personal goods, but also B2B and B2C. When giving my freight charges on a recent B2B movement, I was charging 21% on my invoice. However, my VAT clearance agent said that to avoid double charging of VAT, I have to charge 0% on the international portion of the journey. Can you clarify my obligations as to the freight company? Ronan, it might actually be you for that question, I don't know, but whoever wants to dive into that last question, please do, and I can read it out again if you need to pick it apart.
Yeah, I think it is. I think it's less in relation to customs or duties. It's more actually in relation to the VAT treatment of haulage services. That's a particular nuance. So, when we looked at the supply of services, when you're providing services, domestic freight services within Ireland, it's 20. It's standard rate of VAT. When you're providing services cross border, there is different rules. It's probably one that would require a little bit of thought process. And in reality, the actual the Brexit here, or the withdrawal agreement, hasn't really changed anything from a services perspective as to what's happening in that particular example. So it's probably when I'd say the person will probably just need to look and sit down and see what they're doing and probably obtain specific advice on that one, Chris, I'd say.
Brilliant. Ronan, thank you. Thank you all, panel, for that really interesting run through those questions. I think as our mutual economies try to repair the damage done by the pandemic, trade is so important. Export is the loan that you don't have to pay back in economic terms, and moving value around the economy is how you generate tax that we're going to desperately need to pay down the deficit. So thank you. I'd like to thank Ronan, tax partner at RBK, Brian, MD at SwiftFile, Customs Guru, and Wendy, UK and international and EU VAT expert, for your time and insight this morning. Thank you to everybody that has joined us this morning, and to Deirdre at RBK for facilitating all the technicals and the invites and the social media traffic. Hopefully our audience has managed to take away some learning points there and solutions. Our contact details will be available along with the slides so that people can reach out and get the specific support that they might need. Thank you, everybody, and good morning.
Thank you.